When it comes to the stock market, we've all been trained to pick winners, but my next guest says that we should be focusing on the stocks to eliminate or X out. Please welcome to Stansberry investor David Barse. He is the CEO of XOUT Capital, and he joins us today. David, nice to meet you. Welcome to the show here.
Thank you so much for having me.
So you're trying to create a whole paradigm shift here because, on Wall Street, we've been trained, well, you got to pick the winners, but you're saying not necessarily so.
No, it's really intuitively simple, but still hard for people to get their hands around it, which is we're all trained. Anyone who's spent material time on Wall Street or in finance has been trained to pick winners, to research, learn as much as they can about a company, more than theoretically the market knows, pick those securities and own them over the long term. You will outperform the market. That is sort of the traditional way of doing things. What I've come up with in XOUT is a new paradigm shift, if you will, by simply trying to exclude those companies that are or likely will be disrupted by what I think is one of the most significant forward-facing risks. That's technological change. And so we've come up with a methodology to eliminate those companies that may or likely will be disrupted from a large cap US marketplace and eliminate them in the XOUT index.
So you're placing technology as the biggest risk out there right now?
Let's not say the biggest, because that's a hard thing for me to pin on. I'd say one of the most significant. We spend so much time talking about interest rate risk. And what I've learned over my career, again, is you can't use the word risk without putting an adjective in front of it, or some kind of moniker. So if we're talking about risk, you really need to qualify what you're talking about. From my standpoint, we don't talk enough about, and we don't have our hands or head around technological change. This pandemic proved one thing to everybody. It's that something in a nanosecond could happen that transforms us from a technological change standpoint. And look at what it did to accelerate the change that technology is having on all companies.
I think when you say, eliminating the losers, a challenge when I speak to investors is knowing when to let go of that stock, because there's always a hope, well, I've lost all this money and, I'm just going to wait and maybe things will turn around. So that, how do you overcome that hurdle of, knowing when to let go, David?
Our methodology has a quarterly rebalance. When we eliminate a security, we take the 500 largest, by the way, the largest U.S. equity market capital companies in our constituent base, and then score each of them. But that score is for a quarter. And then after new financial information is gathered, companies file their quarterly financial statements. We take that new data in, and then we rebalance each quarter. So there are instances in which a company that's been X'd out in one quarter might get put back into the portfolio in the subsequent quarter. And that does depend upon how it's performing. So we use financial data to make our decision making.
You also bring up, considering what happened with GameStop, why short stocks? What do you do with a situation like GameStop?
Well, GameStop's not in our constituent base. It may be in the future as its market cap has significantly increased in light of what's happened. And look, even today, we saw that the company made an important decision. They're going to access the capital markets. As we all know, the capital markets are very capricious. They're available, and then sometimes they're not available. For GameStop, they've become available, and they're going to raise a significant amount of capital. Good for them. It's a smart move. Maybe as a larger market cap company now, it could get included in our constituent base. But certainly that's a phenomenon that the management team of that company should take full advantage of and see if they can transform that business into something more than what it has historically been. And I give them credit for how they've handled the situation.
I want to get your gauge on the economy, David. From talking to many experts, often it comes up what we're seeing in equities does not really translate or reflect what the real market out there, the real economy. How do you see it?
Well, I'm a long-term optimist, and if anything has been proven out in the last 12 years, even longer since the financial crisis, growth is key. And companies are continuing to make sound investments in their businesses, to grow their businesses, to take advantage of the way in which the overall economy continues to flourish. And I would say to you that over the long term, companies will continue to grow, and the market should continue to grow. And equities really are the only place to invest. Large cap US equities, which is why we selected this sector of the market as our first index, is the place to be. It has been the place to be, and it will be the place to be in the future. And as an optimist, what we've done, again, going back to the beginning, it's so much easier to just eliminate the companies that are likely to get disrupted, or the so-called losers, than it is to pick and identify the single winners. That is a very hard thing to do. Very few people do it and do it successfully.
Where is there room in a portfolio for you, or maybe there isn't, for other assets, commodities like gold, silver, Bitcoin?
Well, yeah, I mean, look, large cap US equities shouldn't be 100% of anyone's portfolio, but they should be an important percentage of it. A well-diversified portfolio would have to have exposure to things like commodities, and even to a lesser extent, some things like fixed income. Certainly, we haven't talked about it, but cryptocurrency is something that's emerging as an asset allocation tool. And every diversified portfolio should have exposure to even those types of alternative assets. So I look in a broad personal portfolio of having exposure to all things, but certainly one should dominate that exposure to the US large cap equity market. That is the core of all cores, and has been historically, and I think prospectively will be a great contributor to one's growing your net worth.
Please share with our investors some sectors that you're liking right now.
Well, obviously, we have an exposure to technology, but it is not a technology strategy. We have significant exposure to financials. We have significant exposure to consumer staples. We have less exposure to real estate. We have less exposure to telecommunications or communications. We have less exposure to real estate. Obviously, those are industries that are not growing at the same rate as others. And so, as I said from the start again, technology change is impacting all companies. And what you get with XOUT is a cross-industry exposure, if you will, of those companies that are basically doing the right things to avoid technological disruption.
Okay, final thoughts for viewers and investors watching. What would you be looking for, or how would you be playing the market right now?
Yeah, again, I think long-term, day-to-day market gyrations are not something that anybody, even professional investors, as we've seen with the blow up of a large family office, and that's a professional investor, how hard it is to do that day-to-day. Stay long-term, stay focused on your fundamental belief system. I, for one, am a believer in and long-term optimist, especially in US large cap equities. Hold on, watch what has happened even over the last 2 weeks with what was a sort of odd rotation into value, if you will, the going back to work, so-called market rotation, kind of struck me as a little odd in light of the fact that we still have a long way to go before we get back to normal. So certain securities clearly outran themselves, in my opinion. And the companies that are going to produce earnings that we're going to start to see over the next couple of weeks are going to show that, exactly what XOUT is trying to do is where you should stay steady and stay long, because you're going to see some pretty phenomenal performance and earnings announcements from those companies that are continuing to grow, continue to strive. And you're going to see earnings announcements from companies that are losers, that have been X'd out, and continue to sort of surprise how it is that those securities perform the way they did over the last quarter and maybe couple quarters.
All right, David Barse of XOUT Capital, thank you so much for joining us here on StansberryInvestor.com.
Thank you.
And thank you all for watching. We will have much more for you, so be sure to stay tuned. In the meantime, remember to share us where you watch us. That's it for me. I'm Daniela Cambone.